Hi, welcome back to the Lens. Valentina is off today. Really excited. Got Sam Rhines is in the house. All right. One of the great macro minds, wisdom tree, had a macro strategy. Sam, the last time, and Craig Shapiro, great to have you back as well. Uh, Sam, let's kick it off. The last time I saw you in Vail at that great conference hosted by Dick Strong, magnificent conference, your best idea for the year, and you really dropped the floor. I mean, everybody was like, just, my God, where did this idea come from? It was Polish equities. And I look across EM now, and the EPOL, I think, is up like 60% this year. Where'd you get that idea from? And tell us a little bit about how you look at the world.
Sure. So where did I get that idea? It was an interesting confluence of attempting to figure out how to invest around these big macro geopolitical kind of events. Obviously, the big one being what was going on with Ukraine and Russia, right? How was I going to navigate that, but navigate it in a way where it was going to, potentially be very advantageous for a portfolio, right? Looking at the winners, not necessarily trying to find the losers. And it kept coming back to Poland, and it kept coming back to the way that that economy was structured. And then there was a lot of upside, right? There were lots of ways for those equities to win and relatively few ways for them to lose over time. So you kind of thinking of it, kind of back to it, there was a tremendous amount of defense spending going on in Poland. That is a big tailwind for that economy. That's a tremendous long-tailed stimulus. And you began to have rumblings of countries like Germany, France, Italy, Scandinavians beginning to pick up their defense spending as well. And Poland is a tremendous manufacturing hub for pretty much everything in Europe. So all of the pieces were really beginning to come together of, I kind of want to take a deeper dive here, dove into the companies and figured out that, they really were going to benefit from those tailwinds. Not to mention that they had a tremendous number of refugees flowing in from Ukraine that were easily integrated into the economy, and that was that's another tailwind. If the war in Ukraine ends, that would be a potential tailwind as well. Poland makes a lot of metal; they make a lot of concrete. Yeah,
So the rebuild of the
yeah,
Ukraine, the copper, the construction. There's something like 100,000 structures that have to be rebuilt, right? Something like
correct.
that. And so
Yeah.
that's a big bullish driver for copper construction companies. And I think you said there were construction companies in Poland that would be part of that rebuild.
Construction companies, not only in Poland, but construction companies across Europe as well. There were a couple of interesting names. CRH is one of the more exposed to the rebuilding. They recently listed on the NYSE. In the middle of the war, 2013, 2023, 2024, CRH was buying concrete plants in Ukraine and bought so much that the competition, their kind of monopoly watchdog in Ukraine said, wait a minute, you're buying too much of it. So what did CRH do? They sold a chunk of it to the European Bank for Reconstruction and Development. If there's ever a way to guarantee that you get contracts, sell it to the entity that's going to finance the
Right, right.
reconstruction. So it's
Yeah.
going into that deep dive, really did have, call it a long-tailed number of ideas that came from it. Yeah.
Well, congrats to you and Wisdom Tree. The GEOA was launched this week, the new ETF focused on geopolitical upside, avoiding the losers, kind of capturing the alpha on the upside of the winners. Congratulations, GEOA. Look it up. That's the new fund. And that's kind of the concept is you're looking around the world, you rebalance every quarter or so, and then you're trying to find, where's that geopolitical upside?
Correct. Yes, it's an index committee based approach. If we do have some sort of significant event, the index committee can choose to make changes at call it intra-quarter, but generally rebalanced quarterly, attempting to take advantage of these. So you'll see a number of the index holdings that you can find on Bloomberg are going to be, some of the Polish names that are going to do, we think, very well over time. CRH would be one of the names in the index as well. So again, really trying to take advantage of what's going on. Not just, CRH, this is the best part. CRH is also exposed to a lot of the infrastructure spending that is going on in Europe. So it's not just one of those kind of one-off, one way to win if, Ukraine is rebuilt. There's a significant tailwind, and if Ukraine is rebuilt, that's an extra tailwind as well. So again, it's not just trying to find one tailwind from a given geopolitical event. It's trying to find where are the differences between the geopolitical event that might happen, that you might have a 10, 20, 30% chance of happening, and what are the fiscal potential tailwinds. What are the potential tailwinds for that are happening, that we know are happening, right? Everybody's
known
spending a
knowns.
lot of money
Known
there.
knowns
Yeah.
instead of the known unknowns.
Exactly. And kind of reserving that free optionality as well.
Let me kick over to Jose. If you could go back to the CPI chart, Craig. Next week, you were saying we got bank earnings and CPI. I noticed a big move in commodities. What do you think, Craig? Here, this move in commodities. A lot of higher lows there. Could we get, I think, a little CPI shock to the upside?
Yeah, I think the tariff impact so far has not shown itself in kind of the underlying inflation numbers, but the Fed and most economists believe if it's going to come, it should start showing up in this June print, and then for the next few months. And so we'll get that number. And I think the street is expecting a reacceleration of headline inflation for this print. And so, look, I think this is why the Fed has been reluctant to engage on more dovish talk about the rate cutting cycle. They seemingly are surprised it hasn't happened yet, but they're not willing to throw out all the models and about inflation. And when you have these big moves up in underlying commodity prices like we've seen over the course of the last few months.
Yeah, Craig, look at this list here. I mean, hard assets, palladium, what a week. And Craig, thanks for the help on the book. How to Listen to the Market Speak, our new book, has been #1, top 5 this week in Amazon in the money section of finance on Amazon. And it's a book about that transition of hard assets. Craig, what are you seeing here in terms of metals this week versus say equities?
Yeah, look, it's been, it feels like what we've seen over the course, at least for the month of July so far, what we've seen a bit of a momentum unwind where big cap and tech leading and some of the AI focused stuff has stalled out a bit. Software has gotten hit a little bit, and big tech has stalled out, while we've seen a rotation into hard assets and some of the laggard sectors and commodity sectors and value stocks. And so, this week and last week, big moves in palladium. We have the copper tariffs. Trump with 50% copper tariffs has moved copper and copper related names. We had the rare earth deal earlier in the week with MP partnering with the Department of Defense. And so that stock, it had a monster move this week, and that's led to, well, what else is the U.S. government may think about doing? And so silver's having a breakout this week, palladium's breaking out this week, and even today, oil's up 3%. And so inflation break-evens have started to move higher over the course of the last few weeks, and I think that's just going to make it much more difficult for the Fed to start this easing. And look, Sam, this is actually a question for you. I've noticed that the long end, global sovereign long end, has really started to sell off more aggressively, not only in Japan with yields breaking out to the highs, but Germany, 30-year yields in Germany have made multi-year highs today. I'm curious kind of how you think about the global long end here and what investors are saying and thinking amidst all this tariffs and amidst the inflation. Global long end here seems like it's under a lot of pressure.
Yes, I would agree. And one of the things that we pay very close attention to at Wisdom Tree is the reason why, or the reason that we suspect why the long end is moving. So we would say, boons in Germany are probably moving, at least in part, because you have a better growth outlook for the continent over the next 5 to 10 years, which is a positive reason for the long end to be moving higher. Germany probably doesn't need yields quite that low if growth is going to pick up. In Japan, I think there's a little bit more of a potential. Well, there's 7 people that trade the long end in Japan. So,
the Bank of Japan owns 52% of all of their JGBs, right? 52%.
Something along those lines. Yeah. I'm not sure the exact number, but in Japan, you probably have a little bit of risk being priced into the longer end of the curve based on the election coming up next week. So a number of things, plus they have a little bit of inflation, plus, maybe there's a little bit of growth going to happen in Japan. A little bit of a trade war going on, a little bit of that floating into long end as well. So, positive reasons potentially for the reason the Bund is moving up, long end of the Bund market's moving up. JGBs, I'd be a little bit more tentative on the reasoning, and probably if there's a good outcome to the election next week, you could begin to see that come in a little bit.
Sam, we talked about this in our book, How to Listen to Markets Speak, and let me pull it up here. It's a great read up on Amazon. But one of the concepts of the book was that, a decade ago, we were austerity in Greece, austerity across Europe. In the German finance ministry, they had a picture of black zero. That's the old austerity crown. And now, it's been ever since COVID. It's like you said, it's almost like they're copying the United States. They want it. They want that European exceptionalism through fiscal overdosing, and they've gone from really overdosing on austerity to overdosing on fiscal. Now they're going to chase the United States on defense spending. Well, not chase. I mean, that's what Trump wants. And so, really, it's a whole new world. Higher bond yields globally. That gets you kind of a whole different portfolio construction in the new decade. More hard assets, more value, more growth. International equities. Would you agree, or that's kind of the concept of the book?
I would agree, particularly when it comes to looking abroad for those opportunities. For the better part of, call it the last 15 years, it's been just buy the U.S. and ignore everything else, and that's been a pretty good trade over time. Austerity everywhere except here. Now, I do think it's an opportunity to look at where the opportunities over the next decade. A lot of those are going to be in some very call it cheap relative to the US markets. Being able to find those equities with tailwinds to defense spending that are being overlooked, infrastructure spending that are being overlooked, some of the commodity exposed good balance sheet producers. It's time to look at those as well. It's a much different world than by the S&P and by the Qs. It's a much different world than it was, and frankly, Europe is finally interesting. I think that's one of the great shifts. That it's completely different than it was. To me, that's one of the stories that cannot be overlooked.
And Craig, and just to shift gears, thank you, Sam. Craig, one of your observations this week was, the underperformance of credit at the same time, so high yield triple Cs at the same time, the most shorted stocks are kind of rolling over. What does that tell you? What do you think that's telling you by next week?
Look, I mean, you can see by this chart here that Goldman has a most short basket, and it's been kind of straight up, since the April 9th lows here, and more recently to start the quarter, the most short index has really outperformed most of the big caps, and we've seen that rotation,
And so Craig, just for the average person, so when the most shorted index is up, what does that mean? You're going, if it's risk on, it's forcing short coverage.
Yeah, basically, you have, Goldman has a basket of stocks that its clients are, in its prime brokerage books can see kind of where the most crowded shorts are, and it says these are the most shorted names for its clients. And so typically long short hedge funds get crowded in their longs, they get crowded in their shorts, and so we sometimes get unwinds of that crowded positioning, and that's what we've had to start July. And so we've seen kind of a deleveraging of portfolios where folks have had to sell down some longs and cover shorts. And so this idea is that the most short basket outperforming typically happens at the end of a move higher in risk, as we cleanse some crowded positioning on the short side, and so people are losing their shorts. And so that's been going on now for the last 2 weeks, and today is really the first day that we've seen in a while where the most short basket is actually underperforming, down over 1%. We're also seeing credit spreads, which you mentioned, haven't made new tights for this move up in risk. And so S&P and NASDAQ has made new highs, but credits has not gone to new tights. And so a little bit of a negative divergence there. And so when you add in the combination of credit maybe not participating to the same degree as the equity market has, and now this most short basket starting possibly to roll over. Also, some of the levered credit names today are facing some headwind. So to me, it seems like we're at the end of a move here for risk, which isn't surprising into expiry next week and into the move we had.
Look at this RSI on Nvidia.
People are long. People are comfortably long risk. Gross exposure is elevated again. Net exposures have come back, and now that volatility has fallen, vol control funds have been buying hand over fist now to get their weights back up. Last week and again this week, we've seen the drop in some of the readings from early April, which helped those indexes. And so vol control buying has been back, and next week's expiry. And we've seen time and time again, particularly this year, markets have transitioned and switched their direction in expiry weeks, or at the end of expiry weeks.
Explain why that is, Craig. So in other words, as you go toward option expiration, which is next week.
The option weeks, expiry weeks have a buyback of hedges component to them, and so when that is gone, then we don't have that positioning for the next couple of weeks until we get into the next expiry. It increases the probability that other fundamental factors can dictate outcomes in the markets to a large degree, and the flows associated with fundamental players become more important if there is data, or if there is macro data or earnings data that can overwhelm this systematic flow that we've been seeing. And so after expiry, the odds of that are higher. And so there is risk to the market, for the back half of this month. There's earnings risk, there's risk of the Fed, there's risk of a hotter inflation print next week. There's payroll, negative payroll momentum risk. And so with folks as long as we've been advocating, a raised cash dynamic. I know we bought some VIX hedges middle of this week. And so we're kind of signaling to folks, thinking about August and September as being seasonally a time when volatility rises, liquidity evaporates, summer trading. And we have some of these big picture risk items out there with Trump tariffs and tariff tweets every other day. Into the August 1st deadline or the August 9th deadline for China. So, it seems like some digestion is coming down the pike here.
And thanks, Craig. And so it's Craig and Sam, but Sam, one of the things people are talking about, so we run a Bloomberg chat. Craig runs the Discord room. Phenomenal job, Craig. Phenomenal job in the Discord room. Family offices, wealth managers, you're coming off a plane, get in the Discord room with Craig and the team, and you get a great download on what the top institutions are really talking about today and this week. And, Sam, this move in software equities, very weak, 20-30% off the highs. Obviously, AI is going to come at, that's a well-known risk, is AI's risk to software. But the divergences in the market are just spectacular. What are you hearing on AI versus software?
Yeah, so it's interesting. It's one that I think has gone largely overlooked. I don't think a lot of people have really paid attention to just how much some of the software names have really underperformed. Like, for example, Salesforce has really started to almost brag about, their AI integration. Microsoft has bragged about it. Adobe bragged about it. And to a certain degree, what I think they're missing is that if you have a tremendous amount of efficiency brought on by AI to businesses, right? Because these are, Adobe, Microsoft, Salesforce, they're basically B2B type companies. And if you have a massive amount of efficiency happening at your customer level, that means you might not need as many subscriptions going forward, right? Those customers might be getting very, very efficient and therefore not hiring as many people, not buying as many subscriptions going forward. So to me, I think there's a little bit of a misunderstanding about exactly what it means for the short run. Maybe in the long run, they can raise prices and that'll make up for the lack of volume. But frankly, I do think there's going to be a period of kind of a head scratching on what does AI actually mean for those customers of the software firms.
Right, right. And, who's the guy under the rock that doesn't know the NVIDIA bull case
I
right
have
now?
no idea.
Is there one guy under a rock somewhere who doesn't understand the NVIDIA bull case? I mean, you've got the entire street has buys on the stock. The street took down the numbers last quarter. They took down the price target. Now they've taken the price target back up. To me, Peter Lynch, my favorite quote of all time, the stock I want to stay away from the most is the hottest stock in the hottest sector, right? Peter Lynch, Hall of Famer.
Oh yeah. And what's interesting is if you dig down into semis, there's still some interesting semi names out there that really haven't performed very well, do need to restructure, do need to catch up. It's one of
Yeah.
you can look at Intel, for example, right? They've fallen behind. But if you kind of dig through it, manufacturing in the U.S., they have a good footprint. They have the opportunity to really streamline operations. To me, it's, there's a really, really hot sector. There's a couple of really hot names, but, you dig down into it and you can still find some interesting plays.
And Craig, what we've been doing, and thank you, Sam. What we've been doing in the palladium and the platinum space, the palladium and platinum, if you take all the gold ever mined in the history of humanity, it would fit into an Olympic-sized swimming pool. All the platinum and palladium ever mined would go up to your ankles in that pool, right? And so Sam, Craig, well, what's going on here with these metals? I mean, they're tiny markets. Are people? Is this where the long end globally hasn't made any money of some long-term treasuries, long-term bonds for 2-3 years now? Like, think about the last 10 years, it was automatic. You made money. The TLT ETF, Sam, is underperforming the EMLC, which is the emerging market local currency bond fund, is outperforming the TLT, that's treasuries, in the 1 year, 5 year, and 10 year. I think that's say 1 year, 3 year, and 5 year bucket. But it's the local currency EM bonds are crushing U.S. Treasuries, Sam.
Yeah, and a lot of that is
that why people are buying commodities?
It has a lot to do with the currency move too, right? Emerging market local currencies are have performed very well against the dollar broadly, at least this year. And to me, weaker dollar generally is a tailwind to the broad commodity complex. And when you add in the potential for a tweet on copper of a 50% tariff. And we had one earlier this year. It's a great chart if you go back and look at when the Trump administration was thinking about putting a tariff on gold, and some of those other tweets back a few months ago. You saw things jump and get a little jiggy. To me, you insert risk into a market that's already probably pretty tight, hasn't had a lot of investment over the last decade. In terms of capacity, you're going to have moves like this. So I do think it's justified, and I do think it's somewhat sustainable over time, particularly given the amount of money that's flowing into infrastructure globally.
Thanks, Sam. Craig, so Buffett's selling his Bank of America stock like it's like there's no tomorrow. Jamie Dimon is selling JP Morgan at his fastest pace ever. So Jamie and Buffett are dumping the banks. And now you have MasterCard and Visa. What are they? Almost 16, 17% off the highs because of AI disruption. Craig, what's going on with the financials here? I think they look pretty vulnerable heading into earnings
Yeah.
next week.
I mean, the other thing you have for MasterCard and Visa is stablecoins, right? I mean, the stablecoin technology and stablecoin positive legislation is really going after payment networks. And so over time, if you have kind of instant payment settlement, the fees that MasterCard and Visa have been able to charge globally are likely to get smashed over time. And so I think that's creeping into the valuations there too. But look, I think for these large cap banks, they're also going to be asked to take on a bigger role in helping to support the treasury market over time, right? I mean, I think there's, this understanding that, yes, they're able to, buy back their stock, but they're going to be, forced into taking down more of treasury issuance over time, whether it's bills or bonds, regardless of what Bessent and Trump ultimately decide, because the foreign bid for treasuries has been moving away. And I think that's, a testament and a function of Trump's erratic talk and some of the threats about tariffs or the threats about capital controls or taxes on foreign capital. And so foreigners are acting with their feet, and they've been selling treasuries, haven't been net buying treasuries for at least the official sector for some time now. And so banks are going to be asked to take on a larger role there. JP Morgan valuation is I think you were pointing out earlier in the week, price to book ratio, maybe it's never even been higher than it's been. And so I think some of that digestion and exhaustion is hitting the space. And, all of them report next week. Expectations are pretty high going into the print, which is, different than we've seen maybe over the course of the last couple of prints. So they're going to have to deliver the earnings in order for the sector to keep moving here. And if not, I think there's, people have one foot out the door.
And thanks, Craig. Sam, silver is making a big move versus gold. The ratio is breaking 90. Silver typically in that kind of gold silver battle. In a bull market, that gold silver ratio is typically in the 50s, 40s, even 30s. But we're just breaking 90, like 89. We're starting to see some clients move out of gold into platinum, palladium, silver. What do you think? Would you diversify into other metals?
I would diversify into silver. I think that's a smart move, and I would argue a lot of the differential this time around is the official sector buying. The official sector really hasn't been one of the drivers of previous cycles, right? Call it since the 70s. The 80s, 90s, 2000s have largely been driven by retail and non-official sector flows. This time you have official sector flows into gold. That's likely part of the reason why you're seeing gold elevated relative to silver. I think it's an interesting time to take a few of those chips off the table on gold and begin to move into silver.
And Mark Benioff, there's a video that's going around about Elon obviously had a problem with the big better deal, right? And Elon has a cabal, and I love the All In podcast, Chamath and the guys. It's a great podcast. They've been making a lot of noise on how we're getting behind on solar, right? And Benioff's out there, and the data coming out of China in terms of the solar implementation in the last 2 months is equivalent to something like 2 nuclear power plants, which is just incredible. And think of those solar panels, and now you think of silver, right? So it's like everyone's mind is on AI, and people aren't looking at some of these traits. If China's really ramping up that solar implementation, that's extremely bullish for silver, right?
Extremely bullish for silver, extremely bullish for copper. It's bullish, I would say, for the industrial metal complex generally, yes.
Right. And well, I think we've covered a lot. I think you have a hard stop soon, Sam. Anything you want to say? First of all, thank you so much for joining us. Wisdom Tree, I'm a big fan of yours, Sam. How can people find you on Twitter?
You can find me at Samuel Rhines on Twitter. Pretty straightforward, and you'll
Okay.
get some of my more interesting takes. The one thing I would leave you with is, as we head into earnings season, pay very close attention to the way that companies are articulating their pricing strategies going forward. With the few that have trickled in so far, ConAgra, for example, stated very, very clearly, we haven't implemented pricing yet. But tariffs and inflation is going to be tariff and just normal COGS inflation is going to be about 7%. We're going to try to offset that in the second half of our upcoming fiscal year. And to be clear, that is early. It's late this year, early next year. So pay really close attention to the timing.
So that's CFOs giving clarity as to how they're going to deal with tariffs. Is that
Exactly,
pretty much?
because that will filter through to CPI, that will filter through to a lot of the metrics. And if you're looking for an instantaneous uptick in CPI from tariffs directly, it might not happen. This might be a little bit of a longer tail to it as well. And just going back to that CPI chart, you're probably going to get a little bit of an uptick due to some of the commodities, and that might not be the only uptick that we're going to see this year.
Right, and break evens, which are inflation expectations, made a big move this week, like 5-year, 10 years are almost breaking out. But Craig, have a great weekend. Anything, have a good weekend with the family, and just you too, Sam. And anything from you,
just
Craig?
One last thing. Just Trump has been talking a little bit more hawkishly about Russia. He made a comment last night that he's going to have an announcement on Monday with respect to Russia. There is a bill that it has massive bipartisan support. I think 80 senators agree on this secondary sanctions bill that would hit any country that buys Russian energy with a tariff of up to 500%. And clearly that's China and India. And if Trump would have, this bill would basically give him unilateral ability to tariff China and India to any degree he wants, whenever he wants, wherever he wants. If he really wants to make a stake about how Russia is behaving in the Ukraine, he'll be able to do it if this bill were to get passed. Massive bipartisan support for the bill already. Not clear how quickly, but clearly it could probably get done pretty quickly since it's already been debated in the Senate and it should pass. So if this happens on Monday, this could be one of those out of left field type risks that the market is not prepared for. How do you deal with it? So just keep an eye on that. He signaled it clearly. He's tacoed before. He's delayed before. But he did say he's getting increasingly frustrated with Putin. An announcement coming Monday. We'll see what happens.
Yeah, he's on the plane with Ted Cruz heading to Texas now, and I imagine he's probably going to call Putin and say, Ted Cruz and these guys are the pit bull. They want to come after you. If you play ball with me in the Ukraine, I'll veto the bill for you. I mean, I could see something like that out of Trump, right? But like you said, bipartisan support. They need a 2/3 vote to get it over the veto. So we'll see. I'm sure that's a good plan for Trump to use that tact and get on the phone with Putin. How to listen when markets speak. It's going to paperback in the fall. Get your copy. We're heading out to LA. Special thanks to the Money Show. We'll be there in Vegas on the 15th and 16th. Then we're doing a nice dinner in San Francisco, an ideas dinner. Same thing in Los Angeles. Reach out to info@thebeartrapsupport.com to connect with us, and we have book signings in the cities of San Fran and LA. And hopefully, Sam, you can come out and join us if you can.
I'll try.
Okay.